Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're going to be taking a look at some trading. So right now we're looking at the Moomoo portfolio. This is where I am trying to turn $1,000 into whatever it is that we can, doing trades for the most part. And since 1,000 isn't a whole lot of capital to start with, I have a lot of covered call ETFs in here, where they're owning the underlying asset and selling covered calls against it, paying out premium to shareholders. And that's what we're seeing for a lot of these. Since the last update, the main things are QYLD paid out 52 cents in dividends and SVOL 30 cents. And then I've been selling covered calls on Southwestern Energy. I've collected 21 cents or $21 in premium thus far, and I'm trying to get another one. I did get assigned last week. I bought back in, so I got a deal on it, but the stock has fallen today. So sadly, I didn't get assigned, or sadly, I didn't get filled on my covered call, and the stock fell. But no big deal there. It's one on the value list as a buy, so I definitely think in the long term it'll be headed upwards. It's just a cheap stock that we can start doing some trades on and collecting some money. $21 in a month off of a $600 investment is not too bad. Outside of this, I think I bought a couple. I bought GLDI, which is a gold covered call strategy, just for some gold exposure. And I bought some more Yield Max. I don't believe that I had Microsoft or Apple the last time we looked at this, and all of this together looks like it should. I mean, these are incredibly high yields. They're risky ETFs. You need to know what you're getting into, because those aren't guaranteed yields, but the yield across the portfolio is 32%. We'll see if that continues. Ideally, I'm generating enough cash to actually buy shares in companies and do covered calls on my own, collect the full premium, not have to pay the management fees. But for a little capital, and that's the strategy I wanted to go with this portfolio, it's definitely turning out pretty well. You see we're up on a lot of our positions, almost all of them, and we're up in the positive $63 over the course of a month, which is very good. And now we'll take a look at some of the things that I'm looking at as trade opportunities, which will have to be in my Robinhood because I don't have the funds over in here. So Tyson, I see Tyson is down towards a lower level. They have some $50 support and they're undervalued. So if we take a look at the Tyson chart, it looks like they continued some fall today, but this is what we're looking at. They are at 52.15 right now, up a little bit after hours, and they have some really strong support right here around $50. I don't think it's breaking down below that. It's close enough. It's a few strikes out. In fact, it is an almost 87% probability of profit. So the market does not have it priced in that this is going to fall below 50. So I actually moved it up, and I say leg one at 50.5, leg two at 50. So a 50-cent spread, which will be $50 worth of collateral for 5-cent premium. So 10%, that's what I like to target. That's a pretty safe. It's a higher return than you would get just having your money in the market on average, but also typically a pretty safe return because you're getting probability of profits mostly 70 and above at that. So I think that I'm going to open 4 of those to collect $20 in premium off 200 in collateral. I feel like that's a pretty safe, easy move. That's in fact what I've been doing, is watching Tyson, and I saw very strong support around that $50 level. And with it staying in that range, I just keep trading and collecting more. I can take a look and see what I've collected total from the stock, but it's a very consistent one for me. Next, I've got SPY. I was looking at some resistance levels on SPY, and I thought that it was going to be tough for it to break 458. And when we look at the chart, we see it's still got some room to run for 458. 459 was its all-time high. Hit a peak there, but we see a lot of touch points on that 458-ish range. And even more recently, it hit a peak around 455. So it's definitely hitting some resistance, looking like it's going to hold in this range, if not dip down. So I figured that'd be a pretty good opportunity to hedge my entire portfolio. Usually if the market goes down, my portfolio in some ways going down. So just an 8% 4-day play, $100 in collateral with a 91% probability of profit, and it'd be making $2 to $3 a day in just theta decay. So I was looking at doing 5 of those for $40 in premium and $500 in collateral. And then Coca-Cola was another one that I had looked at. So I think that Coca-Cola is overvalued. Definitely the Coke v Pepsi video that I did, it looked like both of them were very overvalued and did not have the best fundamentals. So I have owned some Coke. I've been slowly selling out of it. I wish I had sold faster towards that peak. But they pay a decent enough dividend for me to keep that little bit that I have left. And what I'm looking at here is a call spread, 61.60. So currently the stock sits at 58.82. So we're assuming that the stock price is not going to go above 60, which is this line right up here. And I mean, it's definitely headed away from that. We actually see that it is down below its supports. So it looks like it's going to continue on a downtrend. And it is below this trend line too. So even if it does come up, I don't see it, at least in this time frame, getting above. I don't see it getting above 59.5. That'd probably be the best. Maybe even 59 itself. It looks like there was some price action going on there. But I think that would be a pretty easy play. That would be a 15% return, 11 days expiration, 76.8% probability of profit. So this would be a riskier play than all the others, and you get a higher reward with that risk. But it's overvalued. $60 shows some strong resistance and support, and it's just on a downtrend. So I feel like that's a time to capitalize on the premiums. I'd only do one of those because it is pretty risky. 15 in premium, 100 in collateral. And the last thing I wanted to look at was PayPal. So PayPal, I believe that it is incredibly undervalued. And I've seen other YouTubers saying the same, that it's about half of what the fair value is for the stock. But it doesn't pay a dividend, and I don't know how long it's going to take. So I don't really want to buy 100 shares. I don't know how fast it's going to run up. And I want to figure out a good strategy. So one thing I could do is I could just sell a cash secured put. And that's me saying I will buy 100 shares from someone at $62 a share if the stock is below that level by close on Friday this week. And for that, I would be getting paid 0.2 times 100. So that is $20. Now, this one does not have much of a return at all. I would only do one, collect $20 in premium, and have a collateral of $6,200. I mean, I'd be willing to take assignment if I got assigned into PayPal, but that is quite a bit of collateral to put down, and they don't pay a dividend. I don't know how fast they're going to run up. So I was looking at other potential ways. And I have it broken down here. So there's something known as a LEAP. These here are LEAPs, which are long-term equity anticipation securities, where I am buying a $60 call for PayPal that expires in 2025. December 2025, I believe, is the farthest out you can go, at least on Robinhood. And since it's in the money, it acts as if I were owning shares. So every dollar that the share value goes up, this would be going up as well. But you are paying a heavy premium for this. It looks like right now a $60 leap is $2,075, and a 6250 is $1,950. So I looked at it in a few different ways. If I go with the 62.5, if I just bought 100 shares of PayPal, or if I bought a premium's worth for the $60. So that'd be 32.7 shares. Of course, this is going to have the worst return of anything. We can look across here and see if the share price runs up to 70, you make $200. And if it runs all the way up to 90, which would even be on the low end of what we're estimating in a few years, we'd be looking at almost $900 in profit. So you'd be essentially turning 2,075 into 2,950 or something along those lines. But the leaps are very interesting because since I essentially have the security of 100 shares of PayPal, I can sell covered calls against it, and this is known as a calendar spread. So along the way, as long as I can sell $14 a week in premium, I can make back all of my money across the term of the leap. So I'd probably want to, on average, collect $14, $14.50, and then on the 6250, it'd be $15.45 in premium. So about 15.5 in premium you'd want to collect there. But this is where it gets risky. Yes, there's a whole lot less money that you need. I only need $2,075 rather than $6,200. So I need a third of the money to get started with this. But if I get assigned, if it runs up to 70, breaks past my covered call, and I get assigned on it, then I'd be losing $1,000 with no way to get it back. And looking at the 6250, I'd be losing $1,184. There's always the ability to roll, which comes in handy. You can collect higher premiums rolling in the money as long as you're not getting assigned. But that is something to be aware of. Yes, it takes less money, but there is quite a bit of risk. You could lose all of that money that you're putting in from the start. But if it does run up to $70, your appreciation in your leap is $1,000. At the 6250, it's $750. Your shares are only $655. So the leaps are doing better on that front. If it goes to 80, we're looking at 2,000, 1,750, and 1,655. And then if we go to 90, which I think is towards the lower end of what it could have the potential to do, we'd be looking at 3,000, 2,750, and 2,655. So how everything plays out is, assuming you buy a $60 leap and you ride it up to $90, you have $925 in premium for a 44.57% return. If you get the 6250, which is just closer to the share price, $800 in profit, 41% return. And if you buy 100 shares, $2,655 in profit, 41.8% return. Because you're putting so much more money in. You're putting 3 times the money in, and you're only getting 2.5 times the return. So you get a slightly better deal with the leaps. But then once you factor covered calls into this, we're trying to at least make back what we're putting in for those leaps. So like I said, the 14.5, 15.5 average for those two. Once you add in those profits, you're looking at 128% return on the $60 leap, 136.2% return on the 6250, and a 79.7% return on just buying shares. So if I am to do anything with the PayPal, I am definitely leaning towards a leap. I know there's risk there. I've done leaps before. It's definitely not as scary as it looks and sounds. And I would probably go with the 6250 to save some money at the start and end up with the highest return across all of them, assuming that I'm able to collect those weekly average premiums that we're looking. And that is the trades that I'm looking at for this week. So I wanted to see what you guys thought about trade videos. If you want me to continue doing this, I mean, I just scan through the buy and the sell list to see what's towards the high end and the low end and where their support and their resistance are, news, earnings, dividends, and try and find something where I can just kind of scalp a little bit of profit off of. I aim for 10% typically. And I had said that I was going to take a look at what I've made off Tyson. I have that pulled up here now. And Tyson is definitely one of my bigger stocks more recently. I've made $243 off of trading options over the course of the last 4 months. So I'd say that one's a pretty good one for me. Another one that I've had luck with is UNP. I've made $80 over the course of 2 months. Of course, there's stocks like Viatris where I sell covered calls where I've made about 400. But this is the type of trading that I do. I definitely do a much safer. I know my max profit. I know my max loss. I know what's going on. It's not just a speculation play. So let me know if you guys are interested. Please like this video and comment below. Maybe you can let me know what stocks you think that I should look at potentially doing trades on. And subscribe so you can see when they come out. And I'll catch you next time.